Hey all, good morning. This is June 9th before the markets open, and as I was looking last night after hours, there's something that really caught my eye, and it's right here at the top of the screen. It's the VIX. The VIX under 14. I said, whoa, VIX under 14. So if you're in the habit of buying puts and calls, you'll know that there's 6 components that go into the premiums, the prices that you pay. You could call it for a put or a call. And one of those pieces is volatility. Well, volatility being very low as it is here, you can see it hasn't been this low for years. At the peak of 2020, it was at 65. But you have to go back basically to 2019 to get at these levels. So that's really interesting as far as, I don't know, maybe you think that the markets are going to scream higher, as Sven Henrik likes to say, or maybe you think that we're going to have a more pessimistic 2023 second half. Yeah, I don't know, but either way, if you're interested in buying puts or calls, I mean, this is a great opportunity, to pick those up. Now, there's one other thing, I guess, just a frame of reference. We'll look, S&P 500 is basically sitting at 4,300. Dow, NASDAQ, DAX, FTSE, Nikkei, all there for you if you're interested. But look, the other thing is the MOVE index. It's actually Danielle DiMartino Booth. She's over at Quill Intelligence. I think she founded that. She brought my attention to the MOVE once upon a time. And this is the 5-year look back of that volatility index. You can see it's very, very different. It's not at all-time lows at all. I mean, same 5-year look back period. It's really elevated. You know, you could say maybe what's the average of this chart? Maybe, I don't know, 195, somewhere in this range. And we're at 115. So a lot of volatility in this index. This is really the bond index. But I mean, my point is that you don't have to go back long at all before we were below where we are today. Most of 2022 was below where we are today. Pretty much all of 2021. And even the spike March of 2020, it's like 20% higher than where we are now. But I mean, look, just barely higher than where we are right now. So a lot of volatility in this. I want to look to see the VIX, the MOVE index. This is just a little write-up by babypips.com. But it helps us understand what this is. So what is the MOVE index? The MOVE index is a market-implied measure of bond market volatility. So it's not related to the stocks like the VIX is. MOVE index is related to bond markets. And the MOVE index calculates the implied volatility of not just any old bonds, but as U.S. Treasury options, using a weighted average of option prices on Treasury futures across multiple maturities. So these are people basically betting on where interest rates will go. By capturing the expected fluctuations in interest rates, the index serves as a proxy for the bond market's overall sentiment regarding future interest rate movements. So it's measuring sentiment, it's measuring expectation. It was created by this gentleman over at Merrill Lynch back in the day. So why is the MOVE index important? The importance of the MOVE index lies in its ability to provide insights into the bond market's expectations about future interest rate volatility. So, I mean, you could read high volatility, low volatility, but we know what volatility is, right? I mean, we don't really have to have them spell it out for us. And the thing is, this is a calculated number. It's not just expectations. It's looking at the, what did they say? It had to do with the weighted average on options being purchased on U.S. Treasury futures. So it's just the market's willingness to bet on movements on the Treasury. Okay. So then there's this other part, sorry for all the scrolling, but there was this interesting bit in comparison with the VIX index, comparing the MOVE index with the VIX index. So the VIX measures, this says implied volatility in the stock market. So when you compare the two, you can provide a broader perspective on market conditions and the relative risk between stocks and bonds. This comparison can help traders make more informed asset allocation decisions. So typically, the less risky something is, the more people are willing to pay for it. People like that safety. They don't want to lose their money. So if you can give me something that's fairly safe, I'll be more interested in purchasing it generally. So what that means is stocks are fairly attractive with a low risk, just from this one perspective. Not looking at price to earnings or anything else, but just from the volatility in the markets. But really, I think the bigger point to make is if you're an options trader, VIX is very low, premium should be very low. So that's it. Once every 4 years, whatever, we see these kind of moments in the VIX. Yeah, it's a pretty interesting chart. Okay, well, have a great day.